The Sensex is at 60,000 and the Nifty close to 18,000 levels. The Indian equity market is at an all-time high, and thus comes the question whether one should book partial profits or not. Hello viewers, welcome to our channel. In today's video, we will try to present some data, opinions and thoughts as how one can respond effectively in these times. The idea behind this video is to frame the confusion of being invested, book profits, or move out of equities in a spaced manner so that one can profit in the long term. Let's start with the primary question as to why does anything increase in value? One reason suggests that demand outshoots supply. We have seen this situation time and again in cyclical sectors such as oil and gas, power, metals, real estate, shipping containers, etc. The second reason is on account of improvement in earnings, and this is where the stock markets come in. Stocks are a representation of ownership in a business, and the primary purpose of any business is to earn more profitability for its shareholders. So, as long as the business continues to grow, the direction in the stock market will also be upwards. Let's look at the last 20 years of Nifty earnings. The chart suggests that although there have been periods of ups and downs, generally speaking, it has been smooth. Both the index and EPS have a good correlation in the sense that when EPS increases, the index also increases, and vice versa, which means that as long as businesses increase their revenue and margins, stock markets are bound to go up. So, if you are a long term equity investor or buying units of mutual funds over the long term, there is nothing to be spooked about. You do not have to worry about factors such as liquidity, elections, FI buying or selling, geopolitical tweets, and continue to focus on long term revenue growth, earnings growth, operating cash flows, and return on capital employed. Investing is as much a behavioral exercise as it is a calculative one. So while in the previous section we established that earnings propels businesses to grow, however, it is not enough to convince the brain and heart of investors. Every time when the stock markets hit new highs, there are a lot of concerns from investors checking if they should wait for corrections. In other words, investors are not comfortable investing at high levels, which is understood well. Let's examine if this fear is justified or not. To answer this question, we took the Nifty 50 data for the last 20 years to analyze as to how many times the market has hit new highs in these 252 months. So as per data, the stock markets hit new highs in 55 of these months, which is roughly 22% times the market has given superior returns. That is once in every 5 months. Here is an interesting data which suggests that from 2000 to 2020, only 8 times during this year, the stock market has not touched all-time highs. In recent times, the jump has been rather significant. Every year except for 2016, the stock markets touched all-time highs every single year. This goes on to prove that there are good, strong, and thriving businesses which contribute to the stock market growth, and as long as these businesses grow the earnings and margins, it is highly possible and probable that the index will touch new highs every now and then. With this being said, let's play the devil's advocate and discuss the worst case scenarios as to what happened to portfolios which were built when the stock markets were at all time highs. Let's say I invest in January 2000 when the Nifty was at 1592 points. And since then, the Nifty has climbed up steadily to 18,000 levels, which is approximately 11.5 times growth. So even if you had invested at every high, you would have yielded a return of around 6.5 to 9% returns over the long term, which is higher than the inflation rate. Wait, there's more. If you had invested at every all-time high since 2000 without selling them, one would have invested 2,75,000, which is 5,000 into 55 months. Now, these investments today would be worth a staggering 20 lakhs, which would be an annual CAGR of 11%. This having invested only in the months that the index has touched all-time highs. So this goes on to prove that there is no better time or timing in the markets, as this number can be very minuscule in another 25 years from now. So today if we are at 18,000, the Nifty can go to as high as 1 lakh in the next 25 years. Our view is that the time you spend in the market is more important than timing the markets. As we have established in previous sessions by illustrating the case of investing in an index during all time highs. Another point to note from a long term investor perspective is not to develop a trader or a speculative mindset of timing the market owing to news triggers, liquidity, interest rates, weights, etc., which often does more harm than simple and disciplined investing over the long term. Here are some tips to manage your behavioral instincts and how you can manage your portfolio better. Firstly, stick to your asset allocation at all times because asset allocation is crucial to good risk adjusted long term returns, and there are studies after studies that have stressed the importance of balancing your portfolio across different assets like domestic equities, international equities, debt, fixed deposits, savings, gold, and even physical assets like real estate. Secondly, periodic rebalancing of your portfolio. Rebalancing is done to bring your portfolio back on track to your original asset allocation. This exercise ensures that your portfolio's risk is not lopsided and that you can manage drawdowns better. With this, we have come to the end of this video and hope we have been successful in making our investors aware of mistakes and learnings from the past and be a disciplined investor to create financial freedom. Kindly subscribe to our channel and spread the wings of financial freedom and literacy to entire investor fraternity by passing on this video to all concerned. Thanks for watching. Until then, have a nice day.